So one of my goals for this year is to try out different formats, and a podcast is something that has always interested me. And why not? It's a format that puts me in front of knowledgeable people, experts in their field from whom I can understand things in detail and even ask questions. So today I've finally moved out of my comfort zone, and I'm happy to present this podcast episode with Mr. Anupam Tiwari of Groww Mutual Fund as my guest for the day. Here's a small introduction I've compiled on him. Brought up in the small town of Rewa in Madhya Pradesh, Anupam was a standout student. A batch topper in mathematics, he wanted to get into engineering but always had a keen interest in economics and finance. It was a chance meeting with a chartered accountant in Mumbai that helped him decide his path, and Anupam completed his CA in 2004. His career started the very next year with Reliance Capital AMC as an equity analyst, where he was responsible for capital goods, media, utilities and the infrastructure sector. He later joined Principal Mutual Fund as an equity fund manager before moving to Access Mutual Fund in 2016, where he managed their multi-cap, small cap and balance advantage fund. In his most recent role and starting April of last year, Mr. Tiwari is the head of equity at Groww Mutual Fund. In fact, this episode will focus entirely on the BFSI sector, a sector I have been associated with for many years, a sector Mr. Tiwari knows a lot about and has a lot to share, and I'll be sure to summarize the learnings from this talk at the end of this video. Let's begin. Anupam, thank you so much for being here. This is one discussion I really wanted to have because the BFSI industry is where I have spent 20 years, and wow. I've looked at it more from the inside as an operations person, but now, thanks to you, I'll have an opportunity to look at it from the outside in, from an investing perspective. So thank you very much for being here.
Great, Shankar. My pleasure to be with you.
I wanted to start off from the top. So I noticed you did your chartered accountancy and you immediately got into as an equity analyst into the industry. Yes. Is it something that you had planned previously, that you want to do this?
Yeah, kind of. I did. So I was a maths student in my schooling days. I did my 12th with higher mathematics. But then somehow got attracted into markets because of 1997 Southeast Asian crisis.
Oh, okay.
So that was very vivid experience. First time that you are reading about some crisis. You are young, and so that's how I got into stock market. And then I decided to do CA just because I wanted to get into stock market. Then did my own consulting kind of thing for some time. Then needed a better learning. So joined mutual fund industry in 2005 when I joined Reliance Mutual Fund. That time Reliance Mutual Fund, now it is Nippon.
Right.
And worked with great set of people. Then moved to other mutual funds. Work in Principal, worked in Access. Now I'm here trying to set up Groww.
So this is 20 years in a single industry, right? The asset management industry.
Yes.
So it's supposed to be a slightly pressure-oriented industry with so much of expectations from people. Everyone is expecting you to give like the perfect stock, investing. Yeah, exactly, right? How do you manage all this from every angle? Let's say from a behavior angle, from a people angle, from a client angle, from a communication angle. How has it gone for you?
So, couple of things you need to do is, one is that first you need to have your own inherent conviction on this. That yes, this is where wealth can be made, right? So we don't question ourselves every day. We strongly believe that this is an area where significant wealth can be made, and we are highly, you would say a deep belief in that. Then you need to learn the method, because all the chaos. So why armies focus so much on discipline? Why? There is like a madness kind of focus on discipline, right?
Right.
Because war is a chaos. To win in chaos, you need extreme level of discipline. Market is a chaos. Not as high as a, let's say, war.
Right.
But it's a chaos on itself, right? Every day something is happening. There is so much noise. You don't know what will work out, what may not work out. Like a soldier in war who is going to fight, he doesn't know whether he will survive, win or lose, right? In the same way, in market, you are trying to predict future, and you have no clue about how future will work.
Right.
So then the only thing that comes to help you is discipline and method, right? So you follow that method, and you inherently believe in that method. You keep on refining yourself. So with all experience, etc., we keep on refining, and that is why. So investing has two components to it, right? One part is science, which we learn in our academics, right? Financial management, valuation, DCF, etc., etc., financial statement analysis. Then there is an art part to it. which comes from working with your gurus, so your seniors. So they teach you over a period of time. You learn from them and then you evolve. So these two things keep you calm, keep you grounded, and keep you focused on the work. That if you follow the process, outcome will come. And of course, you keep on refining yourself. That where I'm going wrong, because nobody is perfect, right? We all make mistakes.
Right.
For a bit of time, we keep on eliminating our mistakes slowly. We are very cognizant of the kind of mistakes we are making. We keep on looking at back our history, what kind of mistakes we have made, and why not to, how not to repeat them. So these are the things that work for us. And then we keep on reading a lot. We spend a lot of time. We just do this kind of work, right? We don't do anything else.
Right, of course.
Unlike a normal investor who is doing something else
Correct.
and then spending some time.
Correct.
But the core thing is method, and believe in it and follow it with discipline. We don't question the method.
So, I'm not going to ask you a question on mistakes. I'm sure everyone does enough amount of mistakes. But you said something interesting on changing from a science to an art. Anything you recall from the Anupam of 20 years back, what he thought as a science, but now it's kind of becoming more of an art, in terms of your experience.
Yeah. So when you start as an analyst and when you work with, your seniors will give you some companies, prepare a model, do some work.
Correct.
So we used to do that. And we have read all these valuation methodology, right? PE kar sakte, you can
Benjamin
PE,
Graham and
DCF, etc. So we used to believe in it too much. And then over a period of time, we realized that valuation is an art. It's not a perfect science, right? And so we used to say, look, this is a 10p, it is very good stock. This is at 40p, it is a very bad stock. And then we realized that 10p went 50% down, 40p went 50%
Experience
down.
Teaches you value traps. Kya hota hai.
Correct. So that is how, those were the days when you think that you know. And then you realize that, okay, you don't know. You have to relearn everything, and market forces you to do that if you really want to become good in it. So that was very vivid experience of those days.
So will it be true to say that what you learned 20 years back, it's probably just a 10th or 20% of it that comes in use today, or are those old principles still as much valid in your equity methodology that you apply now?
So it's very interesting. We look at it very different ways. So there is a pyramid, which is we call as wisdom pyramid, right? At the bottom, there are 4 stages in that pyramid, 4 stories.
Right.
At the bottom is data. Then there is data interpretation, its analysis. Then there is a framework. Then there is imagination.
Right.
This is how you stack up as a good investor. So the data and data analysis part remains same. It has remained same for more than 100 years. It is the same way you analyze. Same way you look at cash flows, same way you look at valuation, PE, etc. All those things are absolutely same, nothing changes. Then there is a framework. Framework is basically your ground rules. How you will stack up all the data analysis. That generally doesn't change to, let's say, more than 10-20% over a period of time. Because that framework is the core. That is your rule book, how you are playing. Then comes imagination. Imagination changes. That you have to change, because you have to think that what will happen with this data, this company, this sector, 5 years, 7 years down the line. And it is kind of extrapolation of that data and what is coming out of your framework. So you build over a period of time different frameworks to deal with different situations.
Right.
And then you build on top of that your imagination. Right. So that part changes, because what we call market is a complex evolving system, multi-factor complex evolving system, right? Because it is multi-factor because the numbers which were relevant 20 years ago, or the variables, may not be relevant today. They might have lost all their relevance, or they are not as relevant as they were 10 years ago. Right? Then it is a complex and evolving system. Complex because you cannot establish one-to-one relationship. The relationship changes between two variables, right? Someday growth might be very good, someday growth might not be very good.
Right.
In fact, for example, let's look at in a banking perspective. If a smaller NBFC is growing very fast, people actually don't take it positively.
Acha.
Because there could be inherent risk building in, which you will come to know 3 years down the line.
Oh, that their underwriting might be a little lax and stuff like that.
Yes, because you are small, you have not cracked it yet, your processes are not set, but you are growing very fast.
Collection is not good enough.
Correct. So from that perspective, the variables, their relationship changes. So we call it a complex system.
Okay.
We call it evolving system because it is changing in its core structure. For example, to give you perspective, let's say 10 years ago, 2013, imagine that we are sitting in 2013.
Right.
And I tell you that Shankar, India's current account deficit would be 2%, fiscal deficit would be 8%, and US interest rate would be 5%. What will happen to the market? Most of the time you will answer it will collapse.
Yeah, correct.
But it is at all-time high.
Right.
So these are the complexities in the market, because of which you have to create a framework and not rules.
Understood.
And then you have to evolve that framework as the market is evolving. That growth on its own is not necessarily the most important factor.
Right.
Incremental ROE plays a very important role.
Okay.
I would say incremental ROE is a more important factor than growth. If something is growing good rate, but at a lower incremental ROE,
okay,
market will not give it too much value.
Right.
But if something is growing at a lower rate, but very high incremental ROE, market will give it very high valuation. Right. So, give you an example. In 2007-8, we started with great infra journey in this country. Right. In 15-18 years, we have done tremendous investment.
Correct.
But tell me one company which has created humongous value in infra space. Pure infra space, like EPC contractor, a provider of services. Actually, there is none.
Yeah.
Other sectors, other companies have done phenomenally well.
Correct.
It is just because of this factor that your incremental ROEs are not improving and you are having too much competition. So there is pricing pressure, right? You are not able to do generate lot of cash flows.
Right.
You are redeploying your cash into the business, and that business is not generating higher ROE.
Yeah, correct.
So this is the framework you have to build. When you look at pure data,
right,
you may not be sufficiently capable of deriving that. So you need to build it with that framework.
Now there are about 44, 45 different AMCs now in the country. This is a much higher number than where we were even 3, 4, 5 years back, right? So it's really kind of exploded. And then there are other avenues for people, like there is PMS, there is AIF, and there is small cases and stuff like that. So as an investor, it's definitely a problem of choice for me. How do you see the asset management industry itself shaping up? There is no dearth of platforms now, fintechs, and everyone also coming in. Is there? Can you share your thoughts on it? That how do you really see AMC as a business actually moving?
No, it's a phenomenal business. If you look at, one good thing is that once you cross a threshold, then the incremental capital employed is virtually zero.
Right.
So let's say from a size to becoming 10x, 20x, you can become that. You can do your business 10x, 20x without any incremental capital required.
Right.
And that is a phenomenal thing. If you look at any businesses which have been in last 20 years, even grown at 10, 11%, but have not used any incremental capital, the valuation they got is phenomenal, because capital efficiency is core of valuation, right? So AMC has that quality, has that potential per se. Now, in terms of making money in stocks, so opportunity is there, right? We are underinvested in equity.
Correct, absolutely.
That generational shift is happening, so the intensity to invest in physical asset is going down. And it will keep on going down. People will invest more and more in financial assets. So that gives you opportunity. And then it comes to execution. Who can execute it better? Who will be more liked by investors in terms of performance, customer service, etc., etc.
Right.
So those things you need to see.
Right.
Who can build a really good institutional business out of it? So that's how. So it's a very, very phenomenal, promising space. I think it still has big potential to become 4-5x of what we are today.
Understood. And if you can, whatever you can share, how is Groww Mutual Fund trying to cut through this clutter of so many AMCs?
Yeah, so we believe there is opportunity for everyone. We have a very good brand now that we have built over a period of time for last 5-7 years.
Right.
So we are now not a startup anymore. So the whole group is like 1,000 people plus, and we are 7-year-old. So it's not a startup, but we work like a startup. The culture is same. What we are trying to do is that we are democratizing the whole financial space. So we want to give people a very, very, let's say, good option. And we want to become a very respectable AMC. So our target is not to become the best or the largest AMC. Our target is to become a very respectable AMC. One trait that group has is very high amount of customer obsession. The customer is core focus for us across the board. We really think that if we focus on customer his satisfaction, eventually it will play out good for everyone.
Right.
So that's the whole idea even in AMC space.
Let's get into the valuation of AMCs also. That's something of interest to a lot of people. So I was looking at what we generally see, right? So we look at basic valuation and we look at price earnings multiples. So there are 5 listed players at the moment, and there's a massive variation, right? So HDFC is right at top, maybe 40 plus. Nippon is around 33, 34. ABSL, UTI, they are like early 20s. Again, connecting back to what you said about it's not just growth, it's ROE, it's execution, it's the marketability, it's customer, this thing, it's probably the sponsors, the group that's behind you, stuff like that happens. What are the kind of metrics that one should look when one evaluates an AMC business per se, given the different parameters?
Yeah, so almost for everyone, like in AMC business, ROEs are very high, right? Because the capital requirement is too low beyond the threshold.
Exactly.
So that part is given.
Right.
So then the most important factor becomes 2 things. Sustainability of earnings in terms of growth, and what is the execution track record of the management or the company. For any company, not just AMC.
Of course.
Because if past is good, it is more likely that future will also be good. We don't know future, so you go by past, what has happened. So I think as that characteristic stacks up, and that is how you get the valuation differential, etc. In any sector, not just in AMC. And companies evolve, right? Some companies which have not been so good in execution eventually become very good in execution. So then market rewards them. And we have seen that. We have seen companies which used to be traded at 15p have traded at 40, 50p.
Correct.
So that's the whole idea behind, people in same industry, same business, having a very different kind of valuation multiples. And also we look at efficiency of the execution. So who is making more margins?
Right.
Because there is something good with them. They are either having more profitable customer, better pricing power, or their efficiency of operation is better. So that you also look at, what is driving this kind of profitability.
Right. But then that's very relative, right? So when we look at one company versus the other, what are the things that are actually affecting all the companies within the sector? So for example, if today we see a big march happening towards index funds, then the expense ratio goes down. So where the AMCs were earning 1% or so, now it's like 0.25, 0.3%, right? So isn't that like going to affect the asset management business going forward in terms of your margins, etc.?
Yeah, it will play out if you think that index fund growth would be much higher than the active fund growth.
Correct. Right? That's one way of looking at it.
Yeah. So then if product mix changes, your profitability also changes, and then market will discount it very quickly. But we are not seeing that, and I think for at least next 10 years, because Indian market will evolve big time. New companies will come in, some business will go irrelevant, some business will become more relevant, which are less relevant right now. To give you a perspective, for example, let's say, if you look at your wallet share of spend, you look at real estate, right? How much is real estate for overall spending for, let's say, normal person? Even if you look at 10-year or 15-year kind of time frame, it's huge, right? But how much is it in market cap? It's not.
Yeah, it's not there.
Right?
Correct. Yeah.
So it may become more relevant over a period of time.
Right.
So that is where active fund management plays a role, because you can anticipate these kind of things, and before it gets into index, you can build position on that. Right. So this evolution will keep on making active funds very, very important and relevant in the overall portfolio.
Right.
Yes, in very large caps, especially that too, because of Nifty being very concentrated and only 1 or 2 sectors doing very well. So it became very skewed. Even today it is very skewed. So that is why sometimes question comes up, why active fund managers are not performing. But I think that as market evolves, it becomes much more broader. That discussion will take its own backseat.
Yeah, in fact, I was looking at some recent data just on the thing that you mentioned. Like this year, it seems the actively managed large caps have done a lot better than the index funds. But exactly the reverse happened in 2022, and the reverse of that happened in 2021. So is it a case where every year these two are going to alternate? That is, the passive funds are going to do well in the large caps case, and then it's going to be the active funds and again the passive. Is that how it works?
I'm not sure
Okay.
because post 2020 there was sudden change in the whole market space.
Okay.
So everything that was not doing so well, let's say commodities or B2B businesses, they were not doing well till 2019.
Correct.
But they suddenly started doing
Yes.
very well.
Yes.
So, and initially the thought was that it is just supply chain issue. That is why they are making so much profit, etc. But then growth came back and growth sustained, right? So then every fund manager would have changed his portfolio or done according readjustment in the portfolio. So it happens. Sometime it happens, but I think as long as market remains reasonably broad and it is not skewed to very few stocks, active fund managers will have a good playing ground and a good opportunity to outperform the index.
Right. Now that I've broached on the subject, I want to kind of switch over to banking.
Sure.
And you took that real estate example. I think it's a very valid example. So it's basically a case where the wealth of we Indians, it's a lot of it is there in real estate, but it's very underrepresented when it comes to the Nifty. At least in terms of real estate companies, etc. However, the exact opposite is seen with banking, wherein banking as a setup is probably 12, 13, 14, 15% of the GDP. But on the Nifty, it's like almost 40%. That's banking and NBFCs put together. Doesn't this kind of distort the picture of what the Nifty is and what the country as a real economy is doing?
Yeah, so I think you need to look beyond Nifty,
Okay.
Especially looking for India, because there are so many companies emerging across the board.
Right.
If you look at next 300, 400 companies, there are at least 100 interesting companies there. And they're doing a good job. And next 5-10 years, the opportunity there could be very, very good. Of course, valuation might be a question mark.
Right.
When to buy, how to buy. But the way we construct indices is on free float basis, right? So free float for banks is always going to be very, very high. And capital is raw material. So they keep on raising money.
Correct.
Other businesses don't raise money. For example, you look at some of the consumer names.
Correct.
They have not raised money in the last 20 years.
Yeah, the capex is like so small. I mean,
they
don't need the capital.
And they keep on doing buybacks.
Correct.
So the free float is going down.
Correct.
So because of that, the distortion happens. And that is why you need to look at broader indices. That is more important rather than looking at just Nifty.
Right. And is this a phenomena all over the world? I mean, is the US markets and everything also working?
Narrow indices have this kind of problem,
Okay.
especially when one or two sectors do very well. The good thing is in US is that other side of the companies are also equally large.
The tech companies everywhere.
And some of the indices in US are like equally weighted. There is no free float.
Yeah, I think the Dow Jones is
it's equally weighted.
Correct.
So it doesn't impact that.
Right.
There are some indices which are free floated. So those things are there.
Right.
But as market evolves, people will start looking at broader indices. So this problem will get solved automatically.
Perfect. Sounds good. Sounds interesting. Anupam, I also wanted to pick your brains on the banking and NBFC bit. Now, banking has definitely evolved over the years.
Yes.
ATMs and then net banking. I don't even remember the last time I went to a bank branch the last 2-3 years. But there is also news that banks like HDFC Bank, for example, that is going to increase the network of branches by 1,500 branches this financial year or maybe the next financial year. So there's the technology side and there's also the physical side that's going together. So how do you see this entire landscape changing? And I also want you to kind of put a little emphasis on how the PSU banks are going to be over the next 5 years. There's a lot which has happened with PSUs, with the amalgamation and everything. How do you see that also going through? So let's start with banking first.
Great. So as you rightly pointed out that in technology, we have done great as a banking industry. I would say now we are the best, one of the best, like the top of the class in the world.
Right.
In terms of adoption of technology and the quality and capability of that technology in the world. And with this whole digitization playing out, I think it is getting better and better. So there are two things to it, right? One is technology enables you to reach to the customer at a very, very competitive cost. So that plays out because we are a very vast country and the purchasing power is still not that great. So you want to reach to the customer at a fast pace. Second is that it helps you to grow faster. If you have technology, the manual system processes, etc. And our overall size in terms of, let's say, $1 billion might be less, but the kind of activity we do in banking, number of transactions, etc., it's very large because the population is very large, right? So from that perspective, technology is very, very important. Now, why some people are also increasing the physical presence is that you need that customer touch. Because customer still feels comfortable having to deal with a face. He just doesn't want a pure digital thing, right? Because you are putting your hard-earned money, and especially for deposits. That okay, you are still, people are very comfortable doing transactions online. But when it comes to keep their money, especially in tier 2, tier 3, where the digital awareness is slightly lower or the confidence level is lower. So that is why they want a branch. And hence you can cater to the customer in a better way with more trust. And also you can customize your service to the deserving customers. Right? With technology, it's difficult to customize because it is same for everyone. So very, very standard things, you use technology. For a lot of customization, you use physical presence. So that is why almost every bank is trying to increase its presence now. So in first phase, they went with, let's say, top 100 cities or top 200 cities. Then they are going step by step to further. First they capture the market share here, and then they see that they can do the same thing in next level.
The private banks are moving into the public banks domain in terms of a expansive network. Is that how it's?
And eventually it has to happen,
right?
Because once you go to the market where you think you can be most profitable, where viability will come very fast. So these are tier 1 banks, right? Because you need more and more deposits, so your cost goes down, and you are also lending into these areas. Then once you establish yourself over there, you have a balance sheet size when you can invest more. Then you go to the next market.
Right.
So it's a normal evolution for any other, like any other business, where over a period of time you keep on targeting incremental customer.
Right. And with NBFCs also, we kind of see a similar thing happening, where everyone seems to be very aggressive when it comes to, kind of getting more customers into the play, expanding to tier 2, tier 3, coming out with BNPL and all kinds of new products, which is also happening. So again, what's the trigger point there? Like I can remember in 2003, the consumerization of India had happened, so that was a trigger for the private banks to come in, insurance companies to come in. And now I see a massive offtake that's happening with credit growth that's there. Again, what are your thoughts on that?
No, I think it will keep on growing because as per capita income grows, your ability to borrow also goes up, and you want to prepone the consumption. Right? You are young, you want to have some bit more of luxury or better consumption. And you are confident about your earning potential for next 10, 15, 20 years.
Right.
So you think that, okay, let me spend now and enjoy now, and then over a period of time, I can repay the loan.
So everyone's enjoying except the RBI, who's taking out warning letters and telling banks that, be careful with your lending practices, everything.
So that's job of a regulator. Like he's a headmaster of the class, school. So he keeps on telling people, students that, okay, this is the limit, So that is how you maintain the health of the industry.
Right.
And that's very good thing in India, that in last 20 years, we have evolved. And regulator has also learned a lot of things. Banks have learned a lot of things. NBFCs have learned a lot of things. Because we went through multiple crises. So 2007-8 global financial crisis happened, and then whole NPA cycle came in because of large corporate loans going bust. And then Demon happened, then COVID happened, then in between in 18-19 NBFC crisis happened. Two large NBFCs went bust. So from that perspective, there is a good learning curve. So now you want to just be preemptive. So that's good. I think that makes sector more healthy, more sustainable. That's a good part of it. Now coming to NBFCs, there is a set of customers where it is difficult for banks to address their need at a cost competitive basis, right? It requires a lot of different kind of underwriting skills. Banks are very good where data is available. But what if there is no data available? I would say no proper data available. So for example, there is no income tax return available.
Self-employed
persons, or how you value the house or the asset or the machinery, it's not available. Certain time people want very fast loans. Because they see their requirement is next 3-4 months. And then suddenly, we have cyclicality in our country, right? Festive season, etc.
Oh, you're talking about personal loans or it's working capital loans?
Anything. Right? So that is where NBFCs come in, because they have a very different kind of flexible flexibility in their system. Most of these NBFCs are also experts. They are doing one particular kind of thing. So it becomes easy for them to redeploy that learning to different set of customers. So same customer you are doing in one segment. So you have learning of that segment, that requirement.
Right.
For example, I know an NBFC which is expert in dental clinics. So they have highest market share in India in dental clinics. Somehow they have understood that space very well.
So equipment financing, working capital, whatever the clinic requires.
So they do it very fast, whereas other people are not able to do that fast. And over a bit of time in that fraternity, you have created a name.
Correct.
If you want a loan to usi ke paas chale jao, right? So then there are NBFCs which are very good in second-hand vehicles.
Right.
So over a bit of time, you have created your name. You know how to assess, how to underwrite. So you understand the customer, you understand the product.
Yeah, it's one of my previous employers, G Consumer Finance. That was into CDs, right? Consumer durables. It was an expert in that particular thing. Correct. Yeah.
So from that perspective, it is very, very good.
Nice.
Also that because of NBFCs being present there, people are able to convert their asset to capital. And there is very interesting book on this. So there is a gentleman named called Hernando de Soto. He is a Peruvian economist. He was also the governor of the Reserve Bank. He has written a book called Mystery of Capital. It's a very interesting book. A 20-year-old book, I think around 20-year-old. That why capitalism has not worked in most of the countries other than the Western world. And one of them, the focus is how you monetize your asset. How you create a capital out of your asset. That is a big impediment for capitalism to work and growth to happen. And I think in India, we are solving that problem very, very fast. So a lot of time we ask the question, growth kaise ho raha hai?
Right.
Where is growth happening? How is growth happening? Because it is not looking that well in a lot of larger companies' headline data. But it is percolating down and it is broadening up. Because a lot more other companies are coming and working. Their size is small.
Right.
Yes, over a period of time, 90% of these companies may fail. Because it is difficult to scale up. Especially in an NBFC kind of thing or in a leveraged business. Because your one mistake can actually collapse your business.
Absolutely.
Right? And we have seen it in past. But still, there would be companies who will create significant equity value for investors. So it's a very interesting space, growing. And there is a great credit requirement in India. We are underserved in terms of credit. So the growth potential is huge. Even if you look at our retail credit, it is less than 40% of GDP, right? Which is quite low as compared to other countries.
Right.
Some of the developed countries, it is like 100%, 100%, but still it is 70, 80% is the kind of now. We are still less than 40%.
Right.
So there is a big gap to be fulfilled.
You said something interesting on converting an asset into capital, right? So the monetizing part of the asset. Is there a problem with that? So for example, I can take an example of outside of India. So Australia, for example. So equity financing is a big thing, even in the US. So it's basically, assessing the value of the house and then taking a second mortgage on top of it or a third mortgage on top of it. But that's again leading to increase in the asset price itself, because they know there is additional stuff that's possible in the asset and it kind of increase. Isn't that, a negative point when it comes to monetizing the asset?
See, if it goes beyond a threshold, right, where you are just taking it higher and higher without any earning potential of that asset, then it becomes bad, right? And we will see those cycles.
Right.
Certain pockets will go bust. So NPA cycle will come.
Right.
But even then, some good companies will keep on doing well. Their underwriting practices will be good. But it is very important for a country, for an economy, to have ability to convert assets to capital. Because otherwise, the growth will not be broad-based. And it's very, very important. And in fact, Hernando de Soto says this is the core of capitalism to work.
Right.
That then he goes on to title, etc. So yes, at some point of time, some pockets will have problem. But as a whole, it will still be beneficial and it is very good for growth.
Right, got it. You also spoke about, the NPA cycle happening and, we've seen it so many times. So I was employed with ICICI Bank. That's how I started in the banking industry. And I've seen those cycles, where some mistakes have happened in it's gone up and down. it's not uncommon, right? So every 5-10 years, something like this is happening. As an investor, what are those kind of metrics? What are those trigger points that one should really be careful of? So, for example, if GNPA crosses a particular level, how would you suggest a investor kind of look at all these metrics?
So, in fact, generally as an investor, we don't wait for things to get reflected in slippages or what you call as GNPA.
Right.
We kind of try to anticipate that.
Okay.
So how we do is that now banks give very good disclosure in India.
Okay.
So which segment they are lending,
right?
Their segregation of advances, how much is retail, how much is corporate, in corporate how much is SME, how much is large corporate.
Right.
That data is all available. So you keep on studying those data and then try to study backward that is there any risk in those pockets.
Okay.
And what is the over indexation or under indexation of these banks into those areas. We also do a lot of ground level checks.
Okay.
What are the practices, underwriting practices of these banks or NBFCs? So we'll go and meet their customers. We'll go and ask them how you are underwriting. What are the factors you are doing?
So you do the scuttlebutts.
Yes. And then which are the geographies where they are present, and is there any risk in those geographies? For example, in India is very heterogeneous. So some areas are very indexed to let's say industrial growth.
Right.
Some areas are very indexed to agriculture growth. Some areas are in a different way. They are more services, etc. So you have to keep on understanding these things, that where they are exposed and is there any risk building on that. We have to also see that in 20 years, the sector has evolved in a very, very healthy manner. So as you mentioned, during your duration, let's say 2007-8, then we were starting. And a lot of data was not available how things can change. It was, I think, the first phase where India went on to do a lot of corporate expansion and capex.
Correct.
A lot of regulations were also evolving. So those were also a reason for a lot of NPA to come in.
Okay.
Now regulations have evolved, they have matured.
Right.
Because post 1991, it took us 20 years to figure out how to run a capitalistic economy. And that was also confusion. Correct. Because a lot of policies were changing, etc. There were a lot of litigation, court cases, etc. Because of that, also a lot of NPAs came. So people invested on believing in some policy, but then policy changed.
Right.
And you had a problem. And another big impact was because of global financial crisis.
Okay.
Because that kind of dramatically changed the whole outlook for India. And our economy was also big time impacted. And that impact remained till 12-13. When hyperinflation came in, there was heavy fiscal deficit, and then taper tantrum came.
Right.
So the capital availability was also a question mark.
Correct.
But I think that learning is now settled in the banks, even in the regulator. That's a good, and that is a sign you are seeing that RBI it is anticipating it.
Right.
And before anything goes wrong, it is saying just slow down. Right. Just to ensure that nothing, I would say, no calamity should happen. Nothing should come out of blues. So that's a good part. And then we have seen a big change in terms of the overall availability of capital for different segments. So banks evolved. NBFCs, we have seen 2 large NBFCs fail.
Yeah.
But overall sector became more and more healthy. The system also understood how to do things. In 2006, 7, 8, there was nothing called CIBIL.
Correct.
There was no ARC concept.
Right.
There was no IBC. So government regulators learned that there would be problem.
Yeah.
I'm not saying it would be zero NPA. That can never be happen, right? There would be NPAs. But how you handle them, how you become more and more stronger to handle them, and then once it happens, how you deal with them, how you solve that problem. So CIBIL helped you in being preemptive because now you have credit score. Then you have IBC, where you can solve problems faster.
Right.
You have ARCs, who are expert in recovery.
Right.
So you can sell it to them or involve them in recovering the loans, etc. So that evolution is a very, very good thing. So for next 10-20 years, we would be much more healthier.
Right.
But again, I'm not saying that problem will not come. Problem will happen. People will make mistake, etc. But we are in a better shape.
And Anupam, how can investors participate in this BFSI growth story?
Yeah, that's a good question. So there are 2 ways to do it. One is through normal funds, which are diversified. You have some exposure, depending on how the overweight, underweight is stacked up in that fund. And there is another way to look at sectoral funds. Right. So, though I would not suggest too much exposure to sectoral funds, max maybe 10% of your money that you invest in mutual funds should be in sectoral funds, not beyond that. But then eventually it's investors' call how they want to play it. In sectoral funds, you have two methods. Either you can do a passive through an index fund of a particular sector, or you can do an active. Now, both have their pros and cons. For example, what we believed is that in BFSI, active is a better proposition, because what happens is in index fund, there is too much of weight of large caps.
Correct.
So the emerging and growing segments of that overall BFSI space doesn't get too good representation in the overall index. So you're kind of very over-indexed to the large caps.
So that would be what small finance banks and those
Yes,
other things which
market
are
participant, NBFCs,
correct.
All those kind of things, or
CAMS
fintechs,
fintechs, exactly.
those kind of things. So our approach is, and that is what we are going to do, is that we are going to launch an active fund.
Okay.
Because here we believe that, so we are okay with everything. We will do passive, we will do active across the board. For example, we have last fund launched was a passive fund. Again, we are going to launch a passive fund in a small cap space. Right. But here we believe active makes sense. So we are going to launch an active fund. And just because of one fact that it's the representation of larger companies is too high in the index, so you are like very skewed. Correct. There is another angle to it. Very thing is that if you look at history of this sector and the subsectors over last 10-12 years, then you see the subsectors outperform and underperform in a different manner. So everything doesn't go up and down in a similar fashion. So sometimes banks are performing, even in banks, sometimes PSU banks are doing well, private banks are not doing well, sometimes NBFCs are doing well, sometimes market participants are doing well, etc. etc. Sometimes insurance companies are doing very well. So in an active fund, you can kind of optimize the portfolio depending on your outlook in terms of increasing or decreasing weight.
So it's not going to be like a closet indexing kind of a situation happening.
Yes. So we want to have a very active kind of strategy over there. So that's our approach that we believe that is beneficial for investor.
Nice. Great. Makes sense. I also want to move into insurance. That is something which I have spent a lot of time with, both on the life insurance side and the health insurance side. So now there are about 50 plus insurance companies in India. There are those 5-6 PSU players, and there are a lot of private players that's coming in. But for some reason, I don't see the market getting very excited about insurance as much as I see with NBFCs, banks, etc. Is there any particular reason for that?
No, I think insurance companies are doing well. People are excited. There are very few listed right now.
Right.
And there is a market share shift that is happening. We are seeing it, that private sectors are gaining market share and public sector is kind of slowly losing market share. But insurance is a slow and steady business. It's a great opportunity. So there are two things that are going to drive growth in insurance companies. One is the penetration. So we are still an uninsured market, right? The population which should have insurance doesn't have it because there is lack of awareness, and also there is lack of savings, or you say conceptual understanding of how an insurance should work. And a lot of places savings and insurance gets merged.
Correct.
So your ability to buy decent size insurance goes down.
Yes.
Because you have a limited ticket size that you can spend every year. On top of that, as per capita income grows, your requirement of insurance goes up. So for example, today a person requires, let's say, 50 lakh of insurance.
Right.
If his income goes up, he requires 1 crore of insurance. You start with a very little amount of insurance, etc. So as that awareness comes, as per capita income grows, I think that will also drive a lot of growth. Right. So it's a good opportunity, a very great opportunity, and very stable and sustainable opportunity in India.
But from an investor's perspective, do you think, the complicated words which are there in insurance, like embedded value, VNB margins, combined ratio, does it kind of confuse people? It's more technical as compared to a P ratio or a ROC kind of a concept. Is there some reason for that? Actually,
No, I think if you just simplify it, we do one thing is that we simplify everything. Right. So you forget all these names, right? We just segregate like any other company. What is value today? What is the value being created in next 10 years, 15 years, right? That is how you value. Correct. Right? So what is the value today? That is generally what we call is embedded value. Right. How much policies you have issued today? What could be the profitability in that? And then you just discount it and look at that. And then if this company keeps on growing, increasing its business year on year,
right,
how much new value it will create.
That's the VNB part.
Yeah, and you add it to both of them, and then that is the value.
Okay, so it's a bit like a subscription business, right?
Yes.
Yeah.
Correct.
Makes sense. So Anupam, we've now covered all parts of BFSI, most of it actually, banking, financial services, asset management, insurance as well. If I have to kind of put across this as what are the lessons that Anupam has learned over the years, and maybe a positive lesson and a negative lesson. So anything that you want to share that comes to your mind?
Yeah. So if you segregate the whole sector into two parts, lending business and non-lending business, which is more like pure services business. Yeah. It's like, for example, wealth management, insurance, etc. So in lending business, companies or management who has understood the interdynamics of growth and risk is the greatest investment.
Okay.
So people who are only focused on growth may have a problem, who undermine the risk part of it. Or people who have undermined growth and focused too much on risk, they've also not created too much wealth. That is also a problem, because you want to grow. And if you leave some market, somebody else will take it, and then you cannot capture it again. So you need a very, very good dynamics between these two, and the companies have to be able to understand it very carefully and keep on executing on both sides. So those have been very, very good investment. They have created maximum wealth for investors. So that's the great learning, that you focus on both risk and growth, not just on one.
Right.
That's one important lesson for me in the lending side of it. On the non-lending side, it is more like a consumer business.
Okay.
So companies who have been able to create a good brand, a good customer experience, have been very, very successful. And they tend to get more longevity and higher profitability over a period of time. So one has to focus on that.
Right.
Sometimes companies just play on pricing and gain market share, but then it doesn't sustain. So that is one thing you have to carefully watch, that where the customer experience, and compare it more like a consumer company, a brand company.
Right.
So these are two key learnings for me.
Right. And if I were to look over the next, let's say 3, 4, 5 years, which sectors or which subsectors do you think would really, be the next level of growth as far as the BFSI, this thing is concerned? Not just banking, but anything else that's on the anvil that's coming up now.
I think growth can be very broad-based. One thing that we have not seen in the last 20 years in India is stable growth for 6-7 years in GDP.
Right.
Because we have gone through one or other crisis every 4th, 5th year. So because of that, all the segments have not been able to fire. I think we are in a situation where there is a high probability that we can see good, decent growth. When I am saying good, decent growth, even 6% GDP is a very, very good, decent growth for India. If we see it for next 5-7 years, we are going to see growth in every sub-segment. Be it banks, NBFCs, insurance, wealth management, market participants, etc., or other market intermediaries. You'll see growth in everywhere. So depending on valuation, timing, etc., you can kind of build position on each of them. But potential is broad-based.
Yeah, so Anupam, that's all I had for today. Thank you very much for being here. It was a pleasure. All right, now let's organize and summarize what we have learned from Mr. Tiwari today. We started with the asset management industry, and what makes this business unique is that an AMC can grow by 10-20x without needing much incremental capital. When evaluating AMCs, Anupam's advice is to look at the company's execution capabilities, the sources of income, and the sustainability of earnings. I also stirred the active versus passive debate, and Mr. Tiwari's view is that actively managed funds are likely to dominate index funds for at least the next 10 years. In fact, within the BFSI sector, this gap is even more prominent, as BFSI indices tend to concentrate on a few large cap banks, while Mr. Tiwari reckons there are good pockets of opportunity across subsectors and different market caps. It is in this context that Groww is launching a banking and financial services fund to capture opportunities across the sector, and details of the fund can be found on the AMC's website. In the banking space, we are now seeing big growth not only on the technology front, but even in terms of network expansion, as Anupam took us through banking's evolution in India, the regulators' learning curve, CIBIL, IBC, ARC, the NPA cycles, and how everyone has learned, refined, and improved through different crises and situations the industry has faced in the last 20 years, making the system a lot stronger now. On the NBFC side, we learned how these institutions are serving specific consumer profiles with specialized needs like self-employed individuals, dental clinics, second-hand vehicles, etc., thereby giving more people access to capital. Mr. Tiwari also stressed the economic importance of able to monetize one's asset, something he borrowed from Hernando de Soto's book, The Mystery of Capital, which is definitely going into my reading list. A statement that stuck with me is that markets generally offer a better valuation to companies that have high incremental ROE even if the growth rate is moderate, such as the consumer goods industry, while high growth but low ROE sectors like infrastructure haven't seen any prominent multi-bagger through the years. Mr. Tiwari is of the view that insurance is a stable and sustainable opportunity, with India being low on insurance penetration and the higher need for insurance as per capita increases being the big tailwind of this sector. In fact, Anupam himself summarized it well when he said the key growth drivers for a lending business, so banks and NBFCs, are the growth rate and risk metrics, while a non-lending business like AMC, brokerage or insurance should be looked at more like a consumer business with an emphasis on branding, good customer experience and serving profitable segments. So lots of learning in this episode, and I sincerely hope you found this talk useful and informative. If you have any questions or suggestions, please feel free to post them in the comments box below. As always, thank you for your time, and as always, I'll see you 3 days from now. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।